The volatility we saw in markets this week can be unnerving for investors, but veteran investors are finding opportunities. Joining me now, Treasury Partners CIO Richard Saperstein. Richard, thanks so much for coming on the show.
My pleasure.
So you have said that the roots of the turmoil in the market right now actually go way back. Can you sketch that out for us real quick?
Well, since 2008, we haven't had a market-determined level of interest rates. The Fed has injected $9 trillion into the economy, and that has distorted all kinds of asset prices. Witness the fact that we had $16 trillion worth of negative yielding debt, global negative yielding debt, just about 18 months ago. So now you inject inflation into the mix, and a Fed that was pursuing average inflation targeting just up until maybe a year and a half ago, and we've got a combustible mixture, and we're seeing it right now play out in the markets. We're seeing what appears to be the bond vigilantes coming out from their caves, as well as stock market volatility, incredible volatility I'm seeing right now.
So what are you looking for that will give you a signal that, okay, maybe we're near a bottom?
Listen, this is the most common question that I'm getting. If we go to the data, which is what we like to do, the current free cash flow yield on the S&P right now, figure around at $1.5 trillion, is roughly 4.5%. Now, in our work, if the market drops another 10%, you're going to have a 5% free cash flow yield. And just as a reference point, in '08, at the worst period, it was 5.9%. So I think we're at a point where the free cash flow yield is getting attractive. It could likely get more attractive. So I wouldn't be committing capital right here too aggressively.
Okay. One area you do like, and it's really been a great place to hide, at least until this past week, was energy. Can you give us some thoughts on that space and what you like there?
Well, energy is interesting because of the two sides of it. One is obviously the geopolitical events have unfortunately driven the price of oil up dramatically. And that's on top of the last few years where the ESG has limited new exploration and production. At the same time, the oil companies have adopted some incredible financial discipline in the last few years. So headcount or employment in the industry is down by a third in the last 4 years. And what that's done is a combined effect of really skyrocketing the operating and free cash flows of these companies. So right now you can look at anywhere from 10 to 17% operating cash flows. Exxon is 13%, and free cash flow is 10% in Exxon. Now, when you have all that free cash flow, you've got to do something with it. If you're not going out and drilling, well, you're going to return it to shareholders. So that's the reason why we like that sector right now.
And can you give us two more names there?
I would look at Chevron and Canadian Natural Resources. There's some interesting companies in Canada that are outside the geopolitical fray and generating incredible cash flow, with CNQ as being one of them.
You also kind of like big tech here. And that's really interesting because, of course, that dominated the market along with some speculative names for 10 years or so. Are we at the point where those prices have fallen enough that they're attractive, or is it just that macro story is still strong?
I'll give it equal parts to both those points, but I think we have to separate, when we talk about technology, the zero coupon tech companies, meaning those that are burning cash and do not generate free cash flow, and those that are generating copious amounts of free cash flow. And that includes names like Apple, Microsoft, and Google, where, as you just mentioned, prices have come down, and right now the operating cash flow on these companies are anywhere from 5 to 7%. Now, the interesting thing is that if we get into a recessionary environment where the Fed really taps the brakes hard, investors are likely to look for companies with the attributes of this large cap tech, meaning large moats around their business, recurring cash flow, higher margins than the S&P, and to boot, a growth story.
It's a dangerous thing to say, but it's hard to see who can replace Apple and Google, at least on the horizon. Richard Saperstein, thanks so much for coming on.
It's my pleasure. Thanks, Jack.